Hi, everyone, and welcome to my September 3rd, 2020 video conference. We're going to be talking about the 2020 crystal ball. I'll be right back with more information. Stay tuned. So hi, and thank you so much for joining me today. It's September 3rd, 2020. I want to remind you that you will be able to watch this video conference back on my YouTube channel, which is youtube.com/Natalie Pace. Join me there too, because there's, you might get notice of things there as well. You can also watch back my interview with the Schwab Chief Fixed Income Strategist, Kathy Jones, the Senior Index Analyst of the S&P 500, who is Howard Silverblatt, and John Perkins, bestselling authors. So there are other interviews there that are really worth checking out. Today's teleconference is all about what's going to happen for the rest of 2020. I'm going to be showing you some charts and sharing with you data. I've spent the last 3 days talking to colleagues, getting information, looking and reading Federal Reserve minutes, looking at the long list between 700 to 800 bonds that the Federal Reserve has purchased. And, after looking at all of this and digesting it and hearing various comments from, economists and, C-level bankers, that sort of thing, I think we have a pretty good idea of what is at stake, what is at risk, what the Feds are going to try to do, and whether or not they will be successful in what they're trying to do. So far, they have, but will it continue to be successful? All right, so I guess the bottom line, and we're going to be talking about real estate, stocks, bonds, gold, REITs, so real estate, investment trusts that own malls and commercial real estate, but also those private placement REITs that so many of you purchased in the past. We'll also talk about jobs, and we'll talk about your personal budget. I will say the overall outlook has to be a little bit uncertain. And that is because what's happening in the world is very much at odds with what the Federal Reserve Board is doing to try to prevent that from affecting the economy. And also what the White House and all of the Treasury Secretary and all of the secretaries of various government departments are all working together to try to keep prices where they are. So what does that mean? Well, what happens if you put a moratorium on evictions, a moratorium on even foreclosures? Well, that means that for the most part, rents will stay where they are. Real estate prices will stay close to where they are. Now, again, we have to examine whether or not that's going to be effective, given the real world, what's the right word for it? I mean, the real world, really. There's no other word for it. The real world, high unemployment. The world has changed. We're comfortable now working at home. Employers know that we can be productive working from home. That means that those people that were commuting long distances don't necessarily have to do that. That has great impact on real estate in both suburban and urban and rural areas. So we'll talk about all of that. So again, it's basically the real world versus the Federal Reserve Board and the administration, because the administration and the the administration wants to get reelected. The Federal Reserve Board wants to keep the economy stable long enough for us to get through this crisis so that there's no negative or severe negative economic fallout like there has been in the last 2 recessions. So they're trying to rewrite the books. The bottom line here, and this is why I have a job. So in 1999, I met with Nobel Prize winning economist Gary Becker. We were talking about the economy. I said the demographic shift to me looked like we would be entering a period of Japan-like stagnation. We have avoided that with asset bubble infused bubbles, and that has created the feeling of prosperity in the good times and the feeling of the Great Depression in the bad times. So during the dot-com heyday, everybody thought they were rich, 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 and then dot-com stocks lost 78% between 2000 and 2002. And then we had another good run, and up until 2007, everybody thought they were rich, rich, rich. And then we had the Great Recession, and Dow Jones Industrial Average lost 55%. And then we had a nice recovery, and everybody thought that everything was good, 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 and we had the pandemic. Now, prior to the pandemic, all of the things, listen, in a normal world, we could make it through a few months without it being a crisis. But we had already hit all of the asset bubbles before the crisis came. So I do want to share the screen and show you what I'm talking about so that you understand where we are and what is happening in addition to the coronavirus pandemic related cultural shifts that are impacting industries, but there were other things going on. Think of it this way. The Federal Reserve had to go in and purchase treasury bills, money market funds, bonds, bond ETFs, everything, and the kitchen sink in March. And they had to do that before the first stay-at-home order. The first stay-at-home order in the US was March 15th-ish in California. And I think everybody thought that Gavin Newsom was a little bit crazy and heavy-handed. And now, of course, we don't think that much, or at least most states and most people that are dealing with this, or any state who has been through the crisis doesn't think that. So the bottom line is, why in the world did we have to rescue the economy in the first few weeks of the pandemic before, we had high unemployment or any of these things? And this is why. So let me share the screen so I can show you what I'm talking about. Okay, it might take, I think it's this one right here. There we go. Okay, so troubling indicators of asset bubbles. So right here, and I intentionally put it in there, January versus today. So unemployment was low, inflation was low, existing home prices were higher than they were before the Great Recession. The Dow Jones Industrial Average was far higher than it was. And that's not the only indicator that showed us we were a little bit overpriced, not even a little bit, way overpriced in stocks. The NASDAQ, very much higher than it was before the Great Recession, Freudian slip. Corporate credit, the amount that corporations had borrowed was astronomically high compared to prior to the Great Recession. Consumer debt, it's even higher now. It's over 14 trillion, 14.3, high, way higher than it was before the Great Recession. Public debt, absolutely astronomical. Total debt and loans, absolutely astronomical. The Fed fund rate, and this is another, I don't want to go too far into economics, but I'm going to stop the screen share for a minute. During expansions, they're supposed to raise the interest rate. What does that do? Well, it keeps the asset bubbles from forming because corporations can't borrow real cheaply and just buy back their own stock and then carry more and more and more debt. Did you know that over half of the S&P 500 is at or near junk bond status? Half. That's a very big problem. And the feds have been talking about it in their financial stability reports for years, that asset bubbles were elevated. So all of the asset prices, assets are real estate, stocks, bonds, and they were saying, look, the assets are definitely elevated, and the debt is far higher than it's ever been, and it's highly concentrated in those companies that have the worst credit rating, so we're monitoring it. But they didn't do anything about it. Now, this is the other problem, and again, I'll go back to the screen share so that you can see what I'm talking about. So what happens in recessions is that you cut interest rates to get the economy going again. So you can see that before the dot-com recession, we had a lot of room to cut. They could cut 50 points, basis points. They can really cut it. And that boosts the economy because then the corporations start borrowing at much cheaper rates. Same thing can happen in the Great Recession. We had room to cut the interest rates. When we came into this COVID recession, we had no room to cut interest rates because they never bothered raising them during the expansion. Okay, so let's go back to, again, I just wanted to set the stage. I don't want your eyes to roll in the back of your head or you to get too worried about all the things I'm talking about and not know how to use them. We're going to talk about specific strategies that you can use. And if you'd like to fall down the rabbit hole on why I believe what I believe, then you have this data, you have this information. And I want to remind you, a lot of people at the retreat say, Natalie, what do you read? You read the Wall Street Journal, you watch CNBC, blah, 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 blah. None of the above. I read data. I talk to economists. I talk to bankers. I talk to the chief fixed income strategist of Schwab. I do not rely upon other young writers reading press releases to tell me what's going on in the economy. I read the Federal Reserve Board minutes. I look at the assets that the Federal Reserve is purchasing. And I do that so that you don't have to do that. Okay, but I want you to know that all of the information I'm giving you is based in data. It's not based on opinion. It's not based on other people's opinion. It is based in data. Okay, so the outlook is uncertain because we have two warring entities. The economy is in a recession and asset prices are too high. Normally, what happens in that scenario is that the stock market will go down and real estate prices will go down. Now, how long does that usually take? It usually takes about 18 to 24 months for the stock market to hit its bottom. It can take 4 years or longer for real estate to hit its bottom. So the high in real estate was about 2006 and the low was 2011. It took 5 years in the Great Recession for real estate to bottom out. Most of the losses had occurred by 2009, but the absolute bottom didn't come till 2011. So this time around, we know that this recession started officially on February 19th, 2020. So the bottom for stocks, if we go from the historical precedent, would be sometime between maybe October of 2021 and February of 2022. That is something that would be a historical precedent. So it's not a guess or anything like that. So the general weight of what the economy is doing would be that there's great pressure for both real estate prices and stock prices to go down. Same thing with bond prices, and we'll talk about that. So it's really important for you to know what you own, to be properly protected and diversified, and to know what is absolutely safe in a world where bonds are losing money. Money market funds have redemption gates and liquidity fees. Typically, annuity providers don't do well in recessions, and also a lot of annuities are tied to the stock market, so they go down in value. Another thing is that they are not guaranteed by anything except for the company. So as an example, we would not have insurance companies had we not bailed them out in 2008. Will we bail them out again? It's possible, but we are pretty over leveraged. So they may have to decide, like they did in 2009 or 8, which companies are they going to let become insolvent. So there may have to be some companies in all of these sectors, especially the weaker ones, that just have to go under. And if you happen to have some assets tied in there, you have to know what kind of insurance you have. So with banks, you do have FDIC insurance. With annuities, life insurance, you don't. Those go to the state guarantee funds, which are not very healthy right now. Okay, so what we do know is we have asset bubbles, we have high unemployment, we have a moratorium on evictions and foreclosures, and we have a negative outlook on our AAA rating from Fitch, which just occurred July 31st. So all of those things say that you want to be defensive. Okay, so with stocks, how can you be defensive? Well, you can be properly diversified. You can have 4 hot industries, And what is properly diversified? The general rule is always keep a percent equal to your age safe, and then overweight safe if you think we're in a recession. We are in a recession. So the right answer would be, in my view, overweight safe. What we're doing is overweighting 20% safe right now. Now, and then you're going to properly diversify on the at-risk side. So if you're 30 and you overweight 20% safe, then you have half safe and half at risk. At risk means equities, equities means stock. So you could have large cap growth, large cap value, mid cap growth, mid cap value, small cap growth, small cap value, and then 4 hot industries. Now, I'll give you a quick tip. At my retreats, what we've discovered is that the values are not really a value, and that's mainly because all stocks are pretty high. And you don't necessarily want to just take a value in airlines or some company like that, that industry that's not going to be doing so well. So we've been looking for substitutions for our value funds, and we have found some. So it's there are things that you can do in certain years when something becomes a problem. You just go to the store and buy rotten fruit because it's on sale. You go ahead and say, okay, well, what is in season? And look and see if you can do a substitution in your recipe. Okay, what's safe? Now, normally in a normal world, bonds would be safe. However, when you have interest rates pretty close to zero, they aren't that safe. There's many reasons for that. The first reason is that if you want to get any return at all, you have to go very high risk, and it's just not worth it. It's not worth investing in a junk bond to get a 3% return. So if you're getting above 4% right now, you really have to take a good look at what you're invested in, because chances are it's much higher risk than you know. So bonds right now, and again, the chief fixed income strategist, Kathy Jones, even admitted this, and you should check out my interview with her if you are over the age of 40 and you have bonds or bond funds. So she recommended, and I agree with her, that you should keep the terms short and the credit worthiness high. So I would consider in high credit worthiness that you want to stick with the AA and AAA. Do not go with A, because right now everything is at risk of a downgrade. Also, underweight muni bonds, because sadly, states are the ones that are bearing the biggest brunt of the recession. They have to be the ones with the hospitals and the paramedics and all of this stuff, and they have loss of tax revenue right now. Major losses of income, major increases of outgo. That's a toxic cocktail. So what's safe in a world where bonds are losing money? Well, the safest paper asset is FDIC insured cash. However, paper is not necessarily the safest asset to have right now. So we have to talk about that. And we do that for one full day at the retreat. So obviously I can't give away all the things that I would do if I were you, but I can give you some headlines. So I think that getting safe in today's world is a 2-step process. And the first step is that you want to start off with making sure that you keep your money. So there's this FDIC insured cash is a good way to keep your money. There's a Roy Rogers quote that says, "I'm more concerned with the return of my money than the return on my money." And that would be very pertinent today. There's another famous saying, don't reach for yield. And you definitely do not want to reach for yield right now in a world of unprecedented recession, unprecedented horrors in all of the economic numbers, which we're trying to mask with moratoriums and Fed fund buying and all this other stuff. You definitely do not want to be overexposed on the bond side. So the first step is FDIC insured cash. The second step is safe income producing hard assets that you purchase for a good price, considering a post-pandemic world, and all of those words matter. And we talk about that. There are some low-hanging fruit, and it's not all about income property, which actually right now would be kind of a perilous position to be in, because if you have renters, then they can stay there. They can not pay you rent and stay there because there is a moratorium on evictions. You can't evict them till at least the end of the year. Now they would still owe the rent. So again, it's kind of a perilous position for any landlord right now. So, and money market funds have redemption gates and liquidity fees. So you need to read the fine print on anything that you think is safe. Even treasury bills, I would be shorter term rather than longer term. You're just not paid to take on the risk of longer term. And the other risk of long term is an opportunity cost. And even what if you need the money? So let's say that right now you get a 30-year bond from anything and it pays you 2%. Well, what if in 5 years you need that bond? No one's going to buy it from you. So you'd have to discount it. If you paid $10,000 for it, someone might say, well, I'll give you $5,000 for it. So in other words, you'd have to lose money in order to sell it to get your money. That's not safe in my view. Real estate. Real estate was overpriced before the recession. In 74% of US cities, you would have to, it was unaffordable. In places like Boulder, you would have to spend 74% of the average income in order to buy a home. That is unaffordable. So what we're seeing is definitely that we're seeing weakness there. Now, it's not showing up as much in the numbers as it would because of the moratorium on real estate and the moratorium on foreclosures, and both are in play right now. But what we are seeing is elevated homes for sale. We're seeing a flight to the suburbs and to urban areas, because if you don't necessarily have to live in the city right now and it's so expensive and you're spending, 50% of your income on rent or on a home, why would you want to do that if you could move to the suburbs, get fast Wi-Fi, and enjoy a better quality of life and have, more money, not have to put food on credit cards? So a lot of people are making this choice. What also we're seeing is, due to the high unemployment, we're seeing a lot of a very strong trend toward intergenerational housing. So there's lots of move going on here, and a lot of it has to do with work from home, and the other part of it has to do with unaffordability, and the other part of it has to do with high unemployment. So the patient real estate buyer may be in a good position to buy something that they love in a couple of years. If you are anxious to do something now, shop in the shadow inventory for sure. And you have to consider, not only can you afford it really, and also the 3-ingredient recipe for cooking at profit. So you want to know what you own and why you're owning it. You want to definitely pick the leader, and you want to buy low, sell high. In most real estate markets, you would be buying high right now. So you'd have to be a patient buyer in order to buy low, or you would have to shop in the shadow inventory and do a lot of extra work, but that might yield the ability to save even 35% off of retail. We talk about that at the retreat. Also, again, that's a one full day on what's safe, and real estate is part of that. Now, let's look at gold. And I want to share the screen so we can talk about this a little bit. Gold is definitely one of the highlights that let's talk about this. So today we saw a loss of 808 points in the Dow. That was down 3%. The NASDAQ was down 5%. And that's where all of the technology companies that had been so popular were concentrated. Now you might ask yourself, well, if FANG is so hot, and it certainly is, why in the world would people be selling it? And I dealt with that. Like, if you go to the homepage of nataliepace.com, what you'll see is that in my Twitter feed, oftentimes will make comments and then link to it. So I say here, what's up with technology? Why are these stocks taking a plunge today? And then you can click on that blog and you can understand it. I'll give you the cliff notes on the blog. Is that technology was just overpriced. It is very hot, but they are all very much overpriced. It would be like paying $25 for an avocado. It's just, at some point, if you're willing to buy it, some smart farmer is going to sell you all their avocados, even if they're the most delicious avocados on the planet, because they're earning so much by you paying so far above retail. So I also wanted to show you gold. So here is the the fund that tracks the price of gold. And what I did is I clicked on all so that you could see where it was when it hit its all-time high. So it's actually higher today than it was in 2011. And it's had a nice run. So it's almost doubled from where it was in 2016, 2015. So it's had a very good run. The question is, will it go higher? And let's talk about what spurred it to go to its heights here in 2012. It actually started there, right about there, which is August of 2011. So what happened in August of 2011? On August 5th of 2011, it was a Friday, at 5:05 p.m., Standard & Poor's downgraded the US to AAA plus. And about a month before that happened, stocks started diving and gold started soaring. So that is when gold hit its all-time high, was when the US credit was downgraded. And we have that negative outlook with Fitch. So let's take a quick look at that. They just issued the negative outlook. So that doesn't mean that they'll wait a while to downgrade us, and it doesn't mean that they'll downgrade us tomorrow. What it does mean is that they are concerned, and they want the government leaders to know that they are concerned. So if something happens that makes them feel like the things that are of concern are entering into a zone where there's no return, or no return for a little while, then they will downgrade us. They did downgrade Canada a few months ago from AAA. So this is something that would bode well for gold. Obviously, it doesn't bode well for the US, but it does bode well for gold. So as we see here, it did go to its all-time high. So even though gold is higher than it was in 2011, because of the amount of debt that we have gotten ourselves into, let me see if I can pull that chart back up so you can see. So our public debt is now soared to it's actually 26.8 at last check, trillion. And as you can see, that's, that is almost 20 trillion, no, not quite, almost over 19 trillion more than it was in 2007. So we're in, I mean, look, the whole world is in a recession and the whole world is a little over leveraged, but we're really over leveraged. And that does make our credit rating vulnerable. So if we do get downgraded, it does have implications. And I think one of the main implications, other than stock market might go down, real estate market might go down, dollar would weaken, all of those things, is that gold would go up because people get afraid. And when they get afraid of that the dollar's not that strong, they tend to look for what we would call, it's an emotional investment more than anything. But I think what's interesting here, so you would be buying gold high, hoping that it goes higher. I think what's kind of interesting here is silver. Because silver, then that's in this blue, silver did go to its all-time high right around the same time that gold did. So this is April of 2011. And then you see that it went down. And so people started believing in the US economy again after that. And so it went back down, it went back down. And since March, silver, this is one that tracks the price of silver, but silver's basically doubled. So it looks good. But if you were just looking at a yearly thing, you'd say, oh, well, it's too high. I'd have to pay $24 for it, and the all-time high is 27. But if you look at it more from the standpoint of, oh, silver and gold are highly correlated, and the last time silver and gold hit their all-time highs, this all-time high for silver was 47. Then this price does start looking a little more attractive. And by the way, I do think that you still need to be a little bit concerned. Hopefully in the next quarter, in the third quarter, we'll start seeing some recovery for the gold miners. So I'm more right now kind of interested in the price of gold, the price of silver, than I am in the miners, because many of them have had mines closed due to COVID. Let's talk a little bit about those private placement REITs that were so popular because the salesman would say, you are going to earn an income and I'm going to give you 8 or 9%. And people go, gosh, that's great. And is it safe? Oh, it's very safe because you're going to be owning the real estate. Now, first of all, you don't own the real estate. You own stock in companies that own the real estate. And these companies that are privately held don't even meet the standards to be traded on the New York Stock Exchange or the NASDAQ Stock Exchange. That puts them at higher risk. The fact that they're privately held, the fact that they don't give you any financials, the fact that they pay the salesman 6 or 7% commission to sell you the stock, and trying to get your money back can be very difficult. So I do have a warning story. If you haven't already read D&T's story about private placement REITs, it's worth reading. It's in their own words. It's a blog that's posted on my website. If you email our office, we're happy to send it to you. If you own private placement REITs, you owe it to yourself to know the real truth rather than just listening to the salesman, because they are salesmen, they're not analysts, they're salesmen. Let's talk a little bit about crypto. So I'm going to share the screen again. So a lot of people think, oh, well, I'll just use crypto. That'll be like gold. It'll be my hedge against the stocks. But crypto has got two issues. The first thing is, so the NASDAQ was down 5% today and Bitcoin was down 11% today. The other thing, if we look at the all-time high, you can see that it's nowhere near what it was when it hit its all-time high in December of 2017, and that was at $20,000 a coin. And by the way, there's no trader that I know, no Main Street trader that was able to sell for $20,000 a coin. Because the hedge funds get first priority. So there are ways where professional traders are able to get a special dispensation so that their trades will go in front of yours. So that's one of the things. The other thing is that you can't really have a currency that on one day or 1 year is valued at $20,000 and the next year is only valued at $10,000. That's not currency. So people are not actually using their Bitcoin to buy things. It's only really been a trading platform. And then finally, you don't know who is behind it, who is going to guarantee that you actually have that money. So be careful of crypto of all shades, because now there are just a million shades. There's even China, the Federal Reserve Bank of China is actually coming out with a Chinese yuan crypto. And of course, people are excited about it, but I would just be careful and skeptical. That's why we have hot industries. So if you think something is hot, allow it to be a hot slice in your pie. Let's talk about jobs, and this is something I think is actually rather interesting. So if you know anybody who has recently lost their job or is in the airline or retail or hospitality or travel industry, then they should be looking at how they can improve their skills and maybe either be the most desirable person to hire in that industry or maybe even switch industries. So let's take a look at some interesting things. So this is from, oh, hang on, there we go. So these are the fastest growing jobs in the US. Wind turbine technicians, and the salary is pretty good for a blue collar job. Solar photovoltaic panel installers. The salary is pretty good for a blue collar position. So, you know, you can start taking a look at some of these things. Obviously, there's a lot in healthcare. There's a lot that has some computer element to it. But right now, I would definitely be looking at this particular screen. So again, it's the BLS, and if you just Google that, bls.gov, fastest growing jobs in the US, then you'll see this. And if you're in another country, then it may be that one of the government agencies there has the fastest growing jobs in your area. Okay, so the final thing that I want to talk about is your budget. So if you have been impacted by the coronavirus recession in your income, Rather than just hope and pray that everything is okay, I would take a look at the industry I'm in and the prognosis for that going forward. If it's commercial real estate, if it's anything at all to do with real estate or REITs or hospitality, travel, airlines, etc., then A, I would look at my budget, and B, I'd also looking at new career opportunities and how can I improve my skills to maybe qualify for them. But how do you look at your budget again? So the Thrive budget is simple. 50% to thrive, 50% to survive. If your budget has recently changed, you have to redo the numbers. Now, how can you fix that? It's the big ticket items. So it's your housing costs, it's your transportation costs, it's your medical care and your medical insurance. For housing, you now have options because you don't necessarily have to live in the city. Even if you work in the city, you might be able to move rural or suburban, or with intergenerational housing. Maybe it's the family solving the problem together. With regard to transportation, same thing. Your commute is probably a lot less now. You might have commuted an hour before. You might have to get up and commute from your bedroom to your office, your home office. And then finally, if you have medical insurance and you're paying an arm and a leg, you should be looking, especially if you're healthy. If you're not healthy, that may be the best option for you. I'm sorry. But if you are healthy, you should be looking at the health savings plan with a high deductible. The savings you get on the healthcare premiums pay for the health savings plan account, and that becomes part of your wealth instead of making the health insurance company rich. I talk about all these things in my book, The ABCs of Money. The 3rd edition is out now. The 4th edition, I'm going to be updating at the end of the month. So it should be up very soon. I hope that it will be up within 30 to 60 days. Well, let's say 60 to 90 days. All right, so let me show you a couple of other quick things on the screen. And I want to remind you that if you have particular topics that you want in these video conferences, email info@nataliepace.com. You can always call our offices at 310-430-2397. Email is always best. Let's see what else. And often, sometimes it can be that my team can just send you a blog that I've already written, or refer you to a video conference that we've already had. Or it might be, hey, everybody's interested in this, so I'll do a new blog, or I might do a video conference on it. All right, so let me show you a couple of other options for you that I think are really important before we close up. So here's the ABCs of Money, 3rd edition. As you can see, it's $4 if you get the Kindle version. So even if you wanted to read it now and then in 60 to 90 days get the 4th edition, it's not going to break the buck. So go to nataliepace.com, scroll down, and just click on the book cover, and it will take you over to where you can download it. It is an Amazon exclusive. If you want to implement the strategies in the ABCs of Money, that's what the gratitude game is. It's a chapter a day to implement these strategies. We recommend it in audio. If you're a parent, you absolutely want to read the ABCs of Money for college. Also, if you have assets to protect, if you have a 401k or an IRA, or you own your own home, whatever it is, or if you want to start learning how to earn money while you sleep and stop making everybody else rich, join us for the Financial Empowerment Retreat. It's October 3 through 5 online, so you don't have any travel costs. It's also our most affordable retreat. And here's what's really cool about it, is that if you come in, you pay this amount. If you bring in a family member, you pay this amount. If you get up to, I think it's 4 family members, the price drops precipitously. So you can see that this is our most affordable retreat by far. We're really incentivizing families to come together. We've had teens, well, actually we've had children as young as 10 come to the retreat and be some of our best rock stars. You can't start early enough. Of course, the ABCs of Money for college is a good place to start if you have tweens or younger. But if you have a teen, I would absolutely bring them to a retreat, especially at this price. So just call our office at 310-430-2397 or email us at info@nataliepace.com to learn more about the retreat. You can also just go to nataliepace.com, scroll down, click on that banner ad, and it takes you to over to the learn about, you know, the things that you're going to learn and why it's important to attend and all of that sort of thing, including testimonials so that you know what other people have gained from it. All right, I think that's all I got this time. So thank you for joining me. Reach out, and I hope to see you at the retreat itself. Also, I'd love to hear your comments. We want to be responsive to you and your needs. So whatever it is that you are experiencing right now that you need help with, that's our job. And we really like finding solutions for you. I don't like the fact that, you know, we all have a problem, and we do right now. But what I do like is helping you to find the solutions. You don't want to wait until it is overwhelming or a crisis. You can know right now, okay, my budget looks like it's going to be 20% lower or even worse. What can I do right now to change that? And by the way, they're also, I'm glad I even mentioned this. Okay, I'm going to show you one other blog too. Hang on. So if we go to any blog, let's see where it is. Okay, so this is the most recent blog, I believe. Yeah, Crystal Ball for the remainder of 2020. So this one has a lot of additional information on why I'm talking about what I'm talking about with all of these assets. So this is worth reading. It's long and it's laborious, but if you really want to know all of the methodology behind what I just talked about at this video conference, there it is for you. If you scroll to the bottom of the blog, most blogs are not that long, by the way. I try not to make them that long, but this one seemed really needed to have information. But if you scroll down, then you'll see other blogs listed there. And one of them, which is going to be really helpful if your income has changed or if you're worried about your home, protecting your wealth and home. Click on that and read it. There's another one here about 21st century strategies in a recession, how to recession-proof your life. So there's a lot of information here on what you can do now if your income has changed, or if your home, even if you feel equity rich on your home, maybe you better read this article to make sure that that feeling isn't going to be fleeting. Real estate solutions for a post-pandemic world. So these are all going to be very important things for you to get ahead of. If you know that your industry, your job is impacted already or might be going forward, then start looking at what tools are available now. Again, I want to thank you so much for joining me, and I'll be looking at your comments before I sign off completely. And if there's anything in there that Heather needs to follow up on, she will. So thank you, thank you, thank you. Have a wonderful evening. Have a wonderful week. Lean into community, lean into family. What we're finding out right now is that the best things in life are free and priceless. All right, but may as well protect your wealth, and that's what our strategies are here for. By the way, I'm not tooting my own horn. I just want you to know we worked very hard to find time-proven strategies. The pie chart earned gains in the last 2 recessions and has outperformed the bull markets in between. It is a buy low, sell high plan on autopilot for your nest egg. So all you have to do is set it up right and look at it once a year. It's that easy. It's very easy. And that's why we call it the ABCs of money that we all should have received in high school. And the sooner you get this information and implement it, the faster your life transforms. But more importantly, you've now been given a free hall pass that says you have to do this. So do it now. And we're here to help. Thanks again.